Let's talk to Kelvin Tay, Regional Chief Investment Officer for Southern Asia Pacific at UBS Wealth Management. He joins us from sunny Singapore. All right, Kelvin, so what do you see in the markets given that major sell-off we saw on Monday, but then this quick snapback? What is it saying to you?
I think if you look at the Euribor overnight index swap spreads, and if you look at the 10-year French government bond yields, they've actually not spiked up dramatically, which basically means that that the markets think that the risk is basically contained for the time being, and therefore, as a result of that, you're going to see quite a fair bit of a recovery today, actually.
Well, don't you think that there's a divergence in what the equity markets are telling you and what the fixed income markets are telling you? As you mentioned, bond yields are pretty much held steady. I mean, we're looking at U.S. Treasuries, 10-year yields still below 2%, whereas we're seeing a lot of volatility on equity markets.
Absolutely. I think where the equity markets are concerned, I think yesterday you saw quite a fair bit of nervous knee-jerk reaction in the markets itself, and that's why some of the markets actually fell really, really sharply. But I don't think that's sustainable, because I think where the fundamentals of Asia ex-Japan is concerned, the fundamentals are still looking pretty solid and pretty strong. I mean, of course, you will be affected by what's going on in Europe itself, but again, you've got to differentiate between the liquidity risk and the structural risk where things are concerned. And where Asia is concerned, there is hardly any structural risk at this point in time. And in fact, we are probably about to enter a period where actually rates are actually easing in Asia. And therefore, that should also be supportive for equities going forward.
Yeah, but Kelvin, going forward, how much do you care about the political situation in Europe?
It will be an irritant. It will not be something that goes away on a short-term basis. If things get out of hand, it has the ability to actually increase risk aversion in this region as well. Because don't forget that whenever there is a liquidity concern, the liquidity risk is not endemic to a region itself. It's not region-specific. It tends to spread, and it tends to actually contain the global capital markets. Now, going forward, what we're going to be looking out for is basically the Greek situation. Because we think that yesterday, the Greek situation had actually a bigger bearing on the markets than the French presidential elections. And therefore, if the Greek elections, or if the Greek are unable to actually form a government, then things could actually potentially get worse from here.
Okay, but you're still advocating a disciplined buying approach, meaning more defensive. To me, that doesn't sound like a man who's pretty buoyant and optimistic on the European side.
Yeah, I mean, if you look at the real yields in Asia right now, they are still negative in most countries, and therefore the high dividend yielding stocks are likely to be very defensive and more resilient to any sort of a sell-off. But don't just buy stocks. We believe that you should actually complement that exposure with very high investment-grade dollar-denominated corporate investment debt as well, and also complement that with local currency-denominated government debt in some of these countries. That should actually make your portfolio extremely resilient.
Yep, and Kelvin, in the past you've been advocating being bullish on China, but when are we going to get more easy? I mean, people were calling for a RRR cut this weekend. We didn't get it, and people are just still waiting on the sidelines.
Yeah, I think where China is concerned, the easing is likely to be more on a subtle basis than on an explicit basis. And therefore, we shouldn't be expecting too many RRR cuts in the horizon. Probably we should be looking at perhaps a couple of cuts there, not the 3 to 4 that the market was actually looking for earlier in the year. And one of the reasons why is because the inflation numbers are still a little bit sticky at this point in time, even though we think that inflation is likely to ease going through to the year. And also because I think where the Chinese growth is concerned, we're seeing pretty strong evidence of a soft landing and not a hard landing. If the evidence is there that the landing is going to be a little trickier than expected, then of course we can expect a lot more easing. But at this point in time, we think that a lot of the easing is likely to be on a subtle basis, probably from things like credit growth, etc., etc.
Okay, Kelvin, thank you so much for your time today. Kelvin Tay there of UBS Wealth Management.